All right, let's dive right into this explainer. We're looking at how corporate tax policies, specifically depreciation, can literally shape a country's entire economic future. You hear the term global competitiveness thrown around a lot, right? It sounds like this abstract corporate buzzword. But beneath that buzzword is an absolutely fascinating multi-billion-dollar mechanical lever. Governments can pull this lever to either ignite massive economic growth or, honestly, risk some huge financial liabilities. Today, we're unpacking a specific policy proposal that has completely captivated policymakers and really divided economists. So, here's our roadmap for today. We'll start by looking at Canada's productivity investment lag, then we'll break down how capital cost allowance actually works, define full expensing, check out that massive $36.7 billion price tag, and finally unpack the big economic debate surrounding all of this. Okay, jumping right into Section 1, Canada's productivity investment lag. Before we can even talk about the tax solution, we really need to understand the fundamental economic hurdles facing British Columbia and Canada as a whole. Because when an economy is sluggish, policymakers have to ask themselves, what levers can we pull to actually get businesses to spend money and grow? Really, how do you fix a lag in productivity? It's not just about telling people to work harder. It's about giving workers the right tools to work smarter and produce way more value. And the data from the British Columbia Commission on Tax Competitiveness paints a pretty clear picture. It highlights a long history of underinvestment in precisely those tools, specifically heavy machinery and equipment. We're not talking about buying a few new office chairs here. These are massive capital investments. They provide long-term economic benefits, and they are absolutely vital for driving an economy forward. But these overlapping factors are dragging down the standard of living for everyone. It's like a domino effect. Think about it. An aging population naturally slows down economic growth. Combine that with decades of underinvestment in that heavy machinery we just talked about, and boom, you get lagging productivity. And why does this matter to you and me? Because lagging productivity directly holds down disposable incomes. Plus, high taxes reduce the return on investment, the ROI for businesses. A lower ROI means businesses have way less incentive to make those crucial investments in the first place. So, we've got to look at how the tax system could intentionally incentivize the massive investments we need to reverse this troubling trend. Which brings us to Section 2, Understanding Capital Cost Allowance. To really grasp the proposed solution, we have to look under the hood at the mechanics of corporate taxation and how the current rules actually work. This is a great way to illustrate the difference. Say you run a business. Buying a brand new truck is a capital expense, but the gas to run it, that's a current expense. A current expense is recurring, it's a short-term benefit, so a business gets to deduct the whole thing in the year they buy it. But a capital expense, like that big truck, provides a long-term benefit. Because of accounting principles that try to match expenses with revenues, you actually don't get to deduct the whole cost of the truck on day one. Instead, we use what's called the Capital Cost Allowance, or CCA. Since capital assets, trucks, buildings, heavy machinery, wear out over time, the CCA allows businesses to slowly deduct that cost year by year. It's basically the tax system's way of acknowledging depreciation. But, and here's the catch, this is exactly where the friction happens between businesses and the tax code. The absolutely crucial point here is that getting tax relief right now is always more valuable to a business than waiting a decade to realize the savings. It's the classic time value of money concept. A dollar of tax savings today is worth way more than a dollar of tax savings 10 years from now. Businesses do not want to wait around to deduct the cost of their machinery. They want that deduction immediately. Now we're on to Section 3. What is full expensing? This is the proposed policy lever we mentioned earlier, specifically designed to give businesses that upfront tax relief they're craving. Full expensing, which is also known as 100% bonus depreciation, completely changes the game. If Canada wanted to match policies like the U.S. Tax Cuts and Jobs Act, full expensing would let a company write off the whole machine immediately. This drastically lowers their tax bill in year one. It essentially treats that massive capital truck purchase just like buying gas for tax purposes. Pretty wild, right? Now, what's really fascinating here is how the Parliamentary Budget Officer modeled the phase-out of this policy over time. In analyzing what it would look like to mirror that U.S. policy in Canada, the PBO shows this window of absolute full expensing, which is then followed by a gradual step-down. If we follow a business across this timeline, the incentive to invest is massive during that 100% phase. But that benefit shrinks by 20% each year after 2023. This creates a really powerful buy-now psychological effect for corporations. If you wait until, say, 2026 to buy that new factory equipment, You only get to deduct 40% upfront instead of the whole thing. Moving to Section 4, the $36.7 billion price tag. Pulling this massive policy lever comes with some serious fiscal consequences for the government's budget. And this right here is where the debate gets incredibly serious. Matching that U.S. full expensing provision would cost the Canadian federal government a staggering net total of $36.7 billion over just 5 years. Let that sink in. That is a massive chunk of corporate income tax revenue the government is basically foregoing, just leaving it in the hands of businesses. In the first 3 years alone, the government passes up billions in corporate income tax revenue. We're talking $8.8 billion in year one by itself. Because businesses are claiming all those deductions up front, their taxable income totally plummets, and naturally, so do government tax receipts. But there's a twist, because changes to depreciation rates only change the timing of the deductions, not the total amount deducted over the life of the asset. Tax revenues actually become positive in 2025 compared to the baseline. Basically, the government takes a huge hit up front, but collects more later because these businesses don't have any depreciation left to claim. However, while revenues do bounce back a bit in later years, the government also takes on a massive $164 billion liability in unused corporate losses. See, if a business deducts so much upfront that they technically show a loss on paper, they can carry that loss forward to reduce their taxes for up to 20 years. That is a huge lingering shadow over future federal budgets. Finally, Section 5, the economic debate on depreciation. This brings us to the ultimate question. Is sacrificing all that short-term tax revenue genuinely going to fix the productivity lag we talked about at the very beginning? Well, economists are fiercely divided on this. The main argument is whether this policy creates genuine net new investment or if it simply encourages intertemporal shifting. This is the whole heart of the debate. If it creates net new investment, it's expanding the economy. That's a clear win. But if it's just intertemporal shifting, it means the business was going to buy that machine anyway in 3 years, but they just moved the purchase to today to get the immediate tax break. If that's the case, the government is just losing billions in revenue without actually increasing the total amount of long-term economic investment. The Parliamentary Budget Officer's static estimate purposefully leaves out behavioral effects, entirely because the historical literature simply cannot agree on how effective this actually is. We do know accelerated depreciation has been used to spur growth since the 1940s. We also know that highly profitable corporations are the ones who benefit the most, while companies already operating at a loss don't really respond to the stimulus because they don't need the immediate tax relief. And because these policies are usually rolled out during economic downturns, their true impact is incredibly hard to measure. So the big takeaway here? There is no consensus. The data is deeply, deeply conflicted. So, we're going to leave you with this final thought to ponder as policymakers weigh these massive costs against the pursuit of global competitiveness. Is accelerated depreciation the ultimate key to unlocking net new economic growth? Or is it just an incredibly expensive temporary shift? When tens of billions of dollars are on the line, the answer to that question literally dictates the economic trajectory of an entire nation. Thanks for joining me for this explainer, and keep questioning the mechanics behind the headlines.